Do you believe in Friday's rally after that labor report? Because I've certainly got my doubts, and we're willing to keep an open mind here, especially with the CPI inflation print coming out on Thursday, but let's build a game plan that's based on logic and the charts in front of us for the coming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we've certainly got ourselves a green-bodied hammer candle, indicating that yes, the sellers did do a pretty decent job early on in the week of producing a lower low. We'll get to the bar-to-bar count in just a moment, but the buyers clearly responded by making a move back up not only to the opening print, but of course through the opening print and able to close at the highs of the weekly range. So I would say structurally that the buyers are in control here. If we think about location, once again, we already know we produced a bar-to-bar lower low, but we've also produced a lower high. So technically it's a split count on the weekly here with a check mark for the buyers and a check mark for our sellers. But let's take it one step further. Where was the close of this week's bar in relationship to the previous weekly close? Certainly above last week's close and right on par, if not slightly above the prior week's open, which begs the question, if stronger sellers were getting involved at the bottom of both of these weekly ranges, why were they unable to close these weekly bars at the bottom of the weekly ranges? Simply wouldn't make sense, and clearly there's an overwhelming buy-side reaction at the bottom of this as an overall weekly breakdown. So what does that really tell us about the weekly time frame chart? Well, we know we're ultimately in a weekly downtrend with lower highs and lower lows. Is it not unreasonable that the buyers could ultimately search for some sort of lower high to be produced by giving us a counter trend move on the weekly, set some sort of lower high, and then get continuation in the downward direction? It would seem logical based on the back-to-back hammers we have here at a very logical area of support. We're not all the way there yet to the 416.75 level, but we're pretty darn close here on the weekly time frame to produce a monthly higher low, right? A monthly higher low can be produced around this area for the big inverted head and shoulders monthly neckline retest, right? Roughly around this area. You could imagine a monthly inverted head and shoulders like that, break, retest, higher low. We're pretty darn close. Once again, not all the way there, but pretty darn close, and we could see once again a counter trend move start to develop on the weekly. If we take a look at where logical resistance could start to come in, we know that this is a lower high double top, and a back test of the neckline wouldn't be all that unreasonable. We also know that there's a gap here on the daily time frame chart. The level is 436. We'll take a closer look on the daily. That's the possible weekly lower high number 1. Lower high number 2 is a little bit higher up towards this area. Remember that this was a double inside bar on the weekly time frame chart, and also if we extend that to the left, there's a lot of price history at this particular level, and we know that to be at 443. So the market could do something like this, still produce a weekly lower high, keeping alignment with the weekly downtrend, and then look for some sort of trend continuation. To neutralize the weekly trend, you of course would need to produce some sort of equal high closer to 450 or some sort of higher low in the sequence that builds out into the future here. Once again, we talked about logical support and how we're fairly close to our weekly 50 SMA, but it gets better than that. We can throw on our anchored VWAPs on the weekly time frame here. And what you'll notice, if I just rewind this a little bit, we have failed to close a weekly bar underneath the anchored VWAP from back over here. And if we do take out both of the hammer highs and produce a counter trend rally, is it not logical that we could once again produce a lower high at this cluster of weekly anchored VWAPs? I certainly think that the answer is yes, and that would continue our weekly downtrend. Once again, to neutralize, you really need some sort of weekly equal high at this point in time. We also know if we take out our Fibonacci's, the golden zone was roughly around 430. If we take this from the high to the low, and then from the low to the high, and then once again, if we could get a click, thank you, from here up to here. Let's take a look at the 38.2 on the first retracement, right? So the smallest retracement of the bunch is in alignment with this area for a weekly lower high, much closer to that 443 double inside bar bottom of the range back down over here. If we can get above it, it's a good first step to start the counter trend move, but we're not out of the woods from a weekly trend perspective being in the downward direction. Let's take a look at the volume profile, see what's going on from this point of view, and lo and behold, it just gets better and better, doesn't it? We have the highest volume node in the overall volume profile here as confluence with the back test of the double inside bar range lows, once again, 443 is your number there. Notice that we are right in the midpoint of the low volume void between the two places, so the market should be drawn in theory towards either the upper node or the lower node. Because of the lower wicks clearly showing support near this big monthly retest level, I would tend to think that the counter trend once again really has some more merit to travel back up towards this area here. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number is at 437.25, and that clearly would suggest some sort of higher high on the daily time frame chart, but lo and behold, what is this area we just discussed on the weekly, right? This is a potential place for a weekly lower high near the gap fill area. So the expected move is interesting to me from that perspective. If we're contained by the lower bound of the expected move, the number is 421.87. And yes, technically speaking, that would be a very nuanced higher low, but I would call it an equal low for all intents and purposes. In terms of daily trend, the daily trend does remain down, with the overall sequence looking like this: high, lower high, lower high, lower high, and this failed gap up from Friday of 2 weeks ago is the last lower high in the overall sequence, because we did flip into an hourly uptrend here to produce the counter trend move. Technically speaking, yes, there is the opportunity for a daily lower high as long as the SPY remains underneath 430 into the early stages of this coming week's worth of trade. The interesting thing about the potential for a daily trend reversal is if the SPY pulls back and finds a higher low over 425, you can start to make the argument for a daily inverted head and shoulders. All it would take is a breach of the neckline at 430 to really kick off a daily uptrend with lows, higher lows, highs, and higher highs, and that kicks off your weekly counter trend move, right? So you need to flip into a daily uptrend to really produce some sort of weekly lower high with more strength behind it. And lo and behold, once again, the upper bound of this week's expected move is right in that magic zone where we're looking for our first major weekly lower high potential. 436 is the beginning of the gap. The closure is at 438.50. Beyond that, we talked about this as being a big retest level at 443.25. I think we just said 443 even on the weekly, but that's the neckline of this as a daily double top, and really where the FOMC breakdown began from. This could also act as your weekly lower high area, and once again, it would require flipping into a daily uptrend to actually get there. So although Friday kicked off a big move in the upward direction, is it really going to do anything that really changes the weekly time frame chart trend? At this point, I would be a believer that there's too much of an opportunity for a lower high here or a lower high here on the higher time frames. So we might trade short-term longs in the upward direction, but I don't think it's worth looking for a major market bottom just yet. What do we have interesting to the downside? This is still certainly a very weak level on the daily time frame chart. This 420.50 level is weak because the touches to it are so darn precise. That is not the proper end of any given auction in the market. The only saving grace is that we do have our daily 200 SMA down there, and that's typically seen as like the holy grail moving average on your SPY daily time frame chart. It wouldn't be enough for me to sort of disregard the poor structure, but what I might imagine happening is some sort of higher low, give us the daily inverted head and shoulders, right? Kick off a daily uptrend to find the weekly lower high, and then over time, if data continues to suggest a weekly downtrend is on the table, that's where we come back in to repair this level and get the stronger test of your monthly line in the sand, which, as we know, is 416.75. That's a fairly prescriptive outlook, and I wouldn't be overly tied to or attached to this as a particular situation, but it's one way that the market may continue to evolve here. The other thing that could happen, of course, the bears are much more content if we do not find a daily higher low over 425, consolidate down here, sweep the low, and then come in for the test of the monthly line in the sand, once again, 416.75. Things really start to open up underneath that. There's about 6 3/4 points of drawdown towards 410 as your next major level on the SPY daily. What else can we say here? Let's take a look at the trendline analysis. We haven't looked at this on the midweek analysis, so we'll do it over here and have ourselves a look. Remember that the head and shoulders is still projecting a measured move low at 411, which is much more in alignment with that 410 level we were just exploring back inside of the GFR. Once again, if you know what that is, let us know in the comments. The other thing that I find most interesting here is that the trend line is currently being backtested. So a classic rule of technical analysis, right? Prior support turns to resistance once it's broken, and technically speaking, as we said on the daily time frame chart, there is the opportunity for a lower high. It's almost an equal high, but we're not all the way there yet. So is this a key area to watch early on in the coming weeks worth of trade? To me, the answer is yes. If we do see a move in the upward direction, and once again, in all honesty, we could technically flip into a daily uptrend, a back test of the head and shoulders neckline still puts us in almost perfect alignment with looking for a weekly lower high around the gap close area from back down over here. As time continues to progress, obviously as well, the 50 SMA will continue to roll over, and it might be a beautiful moment of confluence where all of that is sitting around that 438.50 level for a potential gap fill reversal and weekly lower high. So you can pretty clearly see where my focus is for the coming weeks worth of trade if we rally and even if we break down. The last thing I want to share with you on the daily time frame chart is all of the anchored view apps from the major bottom in October of last year. And what you'll notice is that all of the players from the major inflection points before the AI mania breakout over here actually defended this band of anchored view apps. So if this is going to bounce, again, say we get a pullback early on in the coming weeks worth of trade, you build a pullback to 425. If we find a higher low there, we're respecting the lower band of anchored view apps here, and then we break the neckline to rally. Where's the cluster of resistance from an anchored view app perspective? Either at the neckline retest, which is the double inside bar weekly area of resistance, right? That's going to be at 440.325, or the very bottom of the view app cluster is right here at the beginning of the gap, right? 436. So no matter how you slice the market right now, if you're looking at a weekly time frame chart, a daily time frame chart, there's a case to be made for a very strong weekly lower high here and some sort of counter trend move to start to emerge on the daily. Let's move on down to an hourly time frame chart here, get a little bit more granular and dissect the price action from what unfolded on the Friday session. So Friday is extremely interesting because with the first intention from the NFP report, we were actually going to be opening on some sort of gap down. You can see that in the past, this was a balance range, right? This is the Tuesday breakdown. Wednesday and Thursday are both inside bars of Wednesday's range. So the intention was to gap down underneath the entirety of the range, but we found ourselves opening back in the midpoint of that range. That to me is still interesting because any longs who participated on the Thursday afternoon consolidation right up here were still technically opening underwater. Even those who kind of nailed the low down here were a little bit not so easy about their long positions coming into Friday's open. The fact that we drove lower first, to me, should have shaken out the longs from in here, and I'm not a fan of the precise touch right at 420.50. Once again, this is it's too precise. This is the improper end of an auction. We do not have an excess low. The only saving grace is that daily 200 SMA. So we tested the poor low, did not sweep it, leaving poor structure underneath us. There's no hesitation to break through 425. There's no pullback above 425, and we actually reclaim the 428 level, which you might remember from back here, the Thursday of 2 weeks ago now at this point in time. Remember that this offered up your potential reversal with the hourly uptrend, so the reclaim of this level with no hesitation here, and no end of day pullback to even test 428, to me, speaks to a big, almost seismic shift in tone here. Now, again, I'm not pounding the table for a big rally to all of a sudden flip the weekly trend. Again, you know very clearly where my head is at over there, but undoubtedly, this was a strong breakout, and any shorts who are still involved from this 3-day balance are definitely caught underwater with what unfolded on Friday. In terms of what we're looking for going forward, this has been a range double and some. So classically speaking, whenever we break from a balance range, you look to double that range in whatever direction. So we're home from a target perspective, which leaves the door open for the next potential trade to unfold. Before we talk about pathing, let's go ahead and take a look at the anchored view apps and the Fibonacci's because both of them offer a really, I would say, insightful look at the hourly structure. What you'll notice is, again, no hesitation at the anchored view apps, no hesitation at that 428. So is it fair to say that there was a strong buy-side response on Friday? I do believe it's fair to say that, but I do also think that you can still see some sort of lower high set over here because market breadth and internals, basically all of our supporting evidence, is not all that favorable for a strong bullish move at this point in time. So that's the anchored view at perspective. And clearly, once again, if we were to get some sort of pullback, 425 becomes extremely interesting to see if we can turn what was once acting as resistance into potentially newfound support, 425. Before we talk about paths, so I promised you one last thing, which was some Fibonacci's. If we come in from the highs down to the lows, notice that we went right to the 38.2. Not for nothing, but bear flag consolidation, as we know, typically likes to stay underneath the 38.2. If the bears are going to remain in control, pushing it down to 425, some consolidation over here, ultimately leaves the door open for something that looks like this. That still hinges upon the loss of 425. If we do make a move in the upward direction, what's the line in the sand Fibonacci that we always discuss? 61.8. Where is that offering confluence of resistance at this point in time? It's the bottom of the gap. Once again, think about a potential weekly lower high around that area. The last Fibonacci perspective, of course, with a breakout like Friday, let's go from the low up to the high, and we'll zoom in a little bit on this now that we're sort of out of the higher view. And what do you see here, right? So if we're talking about lines in the sand always being the 61.8, you've got confluence with your 425. So buyers technically remain for that inverted head and shoulders outcome as long as 425 holds. It's not beautiful as long as we're chopping around underneath, but the breakout point, which is always the neckline of an inverted head and shoulders anyways, over 430, certainly kicks off your daily uptrend, and also, as you can imagine, the counter trend move on the weekly time frame chart. So I think that I've been extremely explicit about how I'm thinking about this market here. We'll go over the paths just one last time for you. Counter trend bulls want some sort of higher low, ultimately over 425 for the inverted head and shoulders. Here it would be on the hourly time frame chart. Break 430, and you're ultimately looking for over time 436. Do you have to contend with 433.65? Absolutely, but this would be the major area to start focusing on. Counter trend bulls also want to see just straight up continuation here, and then a pullback over 430 to get involved here, retesting ultimately the neckline without a right shoulder building out. If you can get long close to 430, stop goes here, enter here, and you're still looking for this as a major level overhead. Those are the two counter trend situations. You get some sort of, maybe you could consider it like a weird double bottom if you were to think about this as a neckline in here. You get the point at what we're getting at, right? Bears, you guys can trade for a lower high. So let's say that we get some consolidation, a pullback under 428. Bears can actually trade this as a short in here, but just understand that you're trading into a very strong break from Friday's session. I wouldn't overstay my welcome on the short side there, and I would really start to think more so about this being a balance area, right? You're really trying to just take advantage of a short-term down move and then potentially being open to the idea that this can still unfold for the right shoulder. The strongest bearish move, as I'm sure you can imagine, is a lower high underneath that 425. I think it's very clear that a retest and repair of the extremely poor structure at 420.50 is on the table. And then we're looking for that 416.75 level as the monthly line in the sand. Market internals are always supporting evidence exhibit A. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Overall, what we can see here very clearly is that the Monday and Tuesday outflows were far more aggressive to the downside than the inflows from Friday's session. So once again, I have my doubts about the Friday rally. Could it kick off a counter trend move? Yes, but like if new money buyers were truly getting involved, you would have seen a move up and over 300 million. Net flows on the week close out fairly neutral, negative 314 million. If we take a look at the advanced decline line, we know and we discussed the overcorrelated state on Tuesday into Wednesday, but beyond that, Thursday opens and stays under the zero line. Friday has to battle from trend lower zone up above the zero line. Again, credit where credit is due. We did close around positive 1,000, but it's not like we were just hanging out in trend higher zone. It wasn't buy everything on the Friday session. If we take a look at the cumulative builds on the tick, you can clearly see again, bears have the dominance early on in the week. We go flat as we're putting in the double inside bar on the daily. And if you take a look at the cumulative build on Friday, it's technically 4,000. Big, strong reads, 5,000 net positive, net negative are usually what you're looking for there. So although, yes, it was a strong counter trend rally, it was a break out of the inside balance range, I'm not necessarily convinced that we have overly aggressive new money buyers stepping in to buy the S&Ps. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. What was going on with value area and point of control on the Friday session specific to our ES? What you'll notice is that the value area was extremely elongated, but the point of control was able to migrate higher with price and close up towards the highs of Friday's individual range. More importantly, it also closed well outside of the overall balance area from back over over here. If we look at the actual structure of Friday's session, though, what you'll notice is that we have a very well-defined string of single prints here, 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 and at the lows, we put in a little bit of excess underneath this area, but once again, to remind you of the precision, if I just show you this, we went right to the low of the Tuesday breakdown, right? So even though we have, technically speaking, repaired this poor low, the precision, once again, leaves the improper end of the auction from an auction theory point of view. So what we want to watch for here is if the market is able to take out 43.23, the door is open to retrace all of these single prints. And as we know, single prints typically indicate some sort of emotional response to the market. So I would be more so inclined to say that we had a short squeeze outside of this balance area over here instead of some sort of new money aggressive other time frame buyer really stepping in and producing a bottom in our S&P. If we do get some sort of pullback, the retest is back to the highs over here, much closer to 4,300. We have poor lows, and if we are going to repair this area, just to give you the number, it's 4,250. The people have spoken, and they want to see the QQQ after our S&P analysis, and then we'll save the supporting evidence for after the broad market. Let's try it out this week. What's going on with the QQQ weekly time frame chart? That's where we're at right now. If we're looking at structure, just like we do our S&P, we do have a green-bodied hammer, but with much less of a lower wick on the QQQ, so not nearly as much sell-side activity. And once again, the buyers were able to take it back up not only to the opening print, substantially through the opening print for almost a solid green-bodied bar close and a close up near the highs of the weekly range. So structure certainly goes to our buyers. If we think about location on the bar-to-bar count, we do have ourselves a higher low as well as a higher high. So location is also going to go to the buyers. A little bit more bullish over here on the NASDAQ side of things. Don't get me wrong, the weekly trend is still technically down with highs, lower highs, lows, and technically speaking a lower low, but I would be much more inclined to think about the QQQ weekly as a balance range, right? If you draw this in like this, if you wanted to consider this some sort of weekly double top for a trend reversal, bears, sellers, they ultimately want price underneath that neckline, and you can clearly see, based on the close of this weekly bar, we're back inside of that as an overall range. So if we're going to think of this as an overall range, let's not forget the context piece, which is this, and does that not look like some sort of weekly bull flag? I would certainly say that the answer to that question is absolutely. Is it still possible to find a weekly lower high underneath the double inside bar range from back here? The answer to that question is absolutely. 370 is roughly the area of interest, but for the most part, there is relative strength here, even on the higher time frames on the NASDAQ side of the market. Let's take a look at the anchored view apps on the weekly time frame chart. You can see that we're in the anchored view app cluster that could potentially offer some sort of weekly lower high. The one that we're most interested in is acting as confluence around, once again, that 370 area. We're holding this area of the anchored view app from way back down over here, and the anchored view app from the AI Mania is currently acting as a little bit of resistance. Although technically speaking, we did make a weekly bar-to-bar higher high, it was not a substantial higher high. Let's take a look at the Fibonacci perspective here on the weekly, because the golden zone is holding. If we come in from the top all the way down to the bottom, the same sequence that we were just looking at over in the S&P, from here up to here, and then from the AI Mania breakout here up to the top, what you'll notice is that that 350 zone right in here, 61.8, 38.2, 61.8, is holding as confluence of support with that anchored view app in the first place, which once again means that this is a very logical area for the weekly chart to make a stand back in the upward direction. Let's take a look at the volume profile on the QQQ, and what we'll find over here is that we're already at the high volume node. So is it possible that the Qs might struggle, or at least produce more so two-sided trade at the high volume node? It's definitely possible. Just as a general reminder, you never really want to be initiating new money trades out of point of control. That's where the market's most content distributing, in this case, shares. In the case of futures, it would be contracts, right? So two-sided trade could take place here at the point of control. If we do migrate higher and break above the high volume node, I would start to think about equal highs. I mean, on the weekly, if this is going to be a balance area, this might start to become look below and fail, retrace to the top, right? A little bit of a stretch for the coming week's worth of trade, but we're talking about 381 as the top of that area. Notice that we also, at the lows of this week, let me zoom in a little bit further on this, shall we? At the lows of the past 2 weeks worth of interaction, we looked into the low volume void and we did not find sellers in that area. Technically speaking, there's not a lot of volume support until at least in this area, closer to 335, but more importantly, way back down here, the monthly higher low line in the sand is 320. So overall, relative weakness is quite clear in the NASDAQ side of the market. Just like on the S&P, let's start with our expected move. The upper bound of this week's expected move for the Qs is at 372.77, clearly implying some sort of higher high in this overall sequence. That, of course, is bullish. If we're contained by the lower bound, the number is at 356.85 roughly, and that continues this projection of some sort of higher low sequence respecting the overall support trend line that's starting to come into sights. The reason I want to focus on this to begin with is because the daily trend on the QQQ could potentially already be considered reversing in the upward direction. We have a low, we have a higher low set, we have a high set, and we just produced a higher high in a very nuanced fashion in this overall sequence here. Remembering that there's relative strength on the weekly time frame chart, I'm not as concerned about the outcome for a potential weekly lower high until we trade closer to 370, clearly being in an uptrend at that point in time. You'll notice that the Qs had no issues closing their overhead gap. There is no indication of a reversal yet, but we're very open to that idea early on in this week's worth of trade. And I think the daily trend is, or not only the daily trend, but rather the daily pattern really speaks for itself, right? If this is just a balance range, then very simply put, we have balance rules in place. If we're exiting the balance range, we want to look for a double of that range. And lo and behold, that brings us much closer towards that 370 target. And this is just day one of the breakout on the Friday session. It also means that daily traders or intraday operators would look for any sort of higher low over 361.50 to be the ideal location for a higher low on the daily, and then get some sort of continuation up towards that target we just mapped, closer to 370, which also makes a lot of sense from the weekly time frame chart and is still contained within the bounds of this week's expected move. We could take a look at our trend line set over here on the QQQ, and what I want to point out about this in particular is that the Man Ray pattern, you guys will recall that from this right here, right? Basically a head and shoulders, but with a little double top at the top. We never actually broke down through the neckline of the Man Ray pattern. Now, we are technically coming in for a back test of the support trend line, which has broken at this point in time, so you could offer up confluence at the daily 50 SMA, support trend line retest, but overall, this pattern has not triggered, and therefore the suggestion of 320 is a little bit aggressive at this point in time. If you recall back to what we were just talking about from a high volume node perspective on the weekly though, this is still a very important level of potential support on something like a monthly higher low pullback attempt. What else can we say here? Let's take a look at our clean charts, and we will throw on the anchored VWAP study sets and see what's going on from a different cohort perspective. So once again, your AI mania breakout buyers in here, these folks, they're technically doing okay. We're in the midpoint of that band as a range. Anybody who truly nailed the bottom before the breakout is technically back above water as of Friday's close, right? Quote, the average buyer. We also never tested the lower cohort, which was anybody who is buying after the October low at any of the major inflection points. So again, relative strength is quite clear here in the NASDAQ side of the market. Let's take a look at the hourly time frame chart and see what's going on from this perspective and if we have any clear patterns to be thinking about here. So again, no hesitation at the breakout of 361.50, no hesitation at the beginning of the gap or the closure of the gap, and that leaves us with some fairly straightforward situations early on in the coming weeks worth of trade. As we talked about, the ideal pullback is anywhere over 361.50. On the hourly, it's actually above the beginning of the gap at 363. On the hourly, the best thing the buyers could do would consolidate here, turn this into some sort of bull flag, right? And then a break continues for that 370 target. Once again, you certainly have to contend with 367, but the stronger area of resistance, the stronger area of interest is really 370. From a pattern perspective, you might make the argument that this is an extremely sloppy inverted head and shoulders, or that this is just some sort of very sloppy double bottom. It doesn't matter what you want to call it. Ultimately, there is something more substantial happening here in the upward direction. Once again, to set a daily lower high, we actually flip into an hourly uptrend, lows, higher lows, higher lows, and along the way, highs, and higher highs. This also was an equal low. So, okay, if this sets the daily lower high, right, to keep us in a daily downtrend, we flip back into an hourly downtrend, which we do. We get lower highs and lower lows. Now, we're already back in an hourly uptrend, producing once again the daily higher high and the daily higher low. So I think it is fair to say that the QQQ has started the reversal process in the upward direction. It's just a matter of determining whether or not that weekly balance is going to play out, or if we reject here at the 370. Path is quite clear. There's not much to update on there. Last thing I'll show you on the QQQ hourly is just the anchored VWAPs, and clearly we're above the entirety, even the FOMC breakdown band of anchored VWAPs. So that, of course, is a more bullish than bearish indication. As time passes, these will continue to creep up in the upward direction there, obviously. And if we take a look at our Fibonacci's, just to be consistent with the overall approach, coming from here to here, we are above the 61.8. What do we like to say? Usually, the more time you spend above a 61.8, the greater the odds of a 100% retracement. If we do pull back, ideally, you want to see this level hold, and it's not the strongest Fibonacci level, but it would be a 50% retracement of the move from the top to the bottom, and that would be more bullish than bearish, staying in the upper 50%. 61.8 would be ideal, though. Nonetheless, 361.50, there it is the key line in the sand if buyers are going to remain in control. Sellers, of course, want to see something that does this: a break back into the balance range, lower high underneath 361.50, trade to the bottom. Why would that be the target? Because ultimately, this turns into a look above and fail, and that would ultimately be the nail in the coffin. The lower bound of this week's expected move is important at 357. Structurally, we have a lot of price history around that mark, so I would be paying attention to that, but this would be a bearish setup into the early stages of the week, lower high underneath 361.50. The last Fibonacci perspective I'll share with you is from here to here. And you can see your 38.2 picture perfect bull flag consolidation in relationship to the breakout from the Friday session holds on to, lo and behold, 361.50. Volume flow is not as bad on the Monday session, but certainly just as bad on Tuesday in comparison to our S&P. And just like the S&P, we did not get substantial inflows on the Friday rally. Net flows on the week are negative 145 million. In terms of the advanced decline line, way over correlated on Tuesday, corrects on Wednesday, and you can see that we work our way from trend lower zone towards higher in the overall session, but not to trend higher zone explicitly on the Friday rally. Cumulative ticks are really the nail in the coffin. Big downside reads Monday and Tuesday, and on Friday's rally, I mean, we hardly get anything in the upward direction. So it speaks to probably looking for a pullback first before looking for continuation. NASDAQ market profile shows us that the value area and point of control also migrated higher with price on the Friday session, taking out and closing above the overall top of the balance range in here. And we do have an excess low at the bottom of the move, and we also have a deeper lower low from back down over here. So the low has much better structure over on the NASDAQ, but it doesn't mean that we can't have an individual poor low, because Friday's low is in fact a poor low and a mechanical low, being extremely equal to the low of the Thursday session. You can also see the same strings of single prints in here. If the NASDAQ were to break down underneath roughly 15,020, we would expect a stronger rotation to the downside that would really kick off more of your look above and fail situation we discussed over on the QQQ. Just like the S&P, we would have a similar comment in which these strings of single prints here, paired with really weak market internals on the breakout from Friday, speak much more towards short covering as opposed to new money buying. IWM weekly time frame chart, then we're going to move on into some of our classic supporting evidence. What do we see here from a candle structure and location point of view? It's a red-bodied hammer. One of these things is clearly not like the other. There continues to be a lot of relative weakness over on the IWM. So a lot of selling pressure, clearly way off of the opening print when the buyers did finally end up responding. It's only towards like the midpoint of the weekly range, not even close to recapturing the opening print. We've also closed firmly underneath the prior week's range, and you can clearly see on the bar-to-bar count from a location point of view, we have ourselves a bar-to-bar lower high and lower low. The only saving grace here is that the weekly time frame chart is trying to hang on to key support, trying to find buyers at the 170 level, and we've ultimately made it, quote, home from the head and shoulders pattern measured move perspective, right? Head to neckline and then double that for your sort of target. We're basically home, maybe a little bit shy, but for the most part, 170 is key support. If we break down through that on the weekly chart, you can clearly see the next stop below, if we're cherry picking those lows, is much closer to like 163, furthering downside pressure over here in small caps. It should not really come as a surprise then that we are firmly underneath all of the major anchored VWAPs that we have attached to this chart. So that, of course, is a bearish indication. even if we were to rally, there's a very clear opportunity to retest sort of the breakdown point of the head and shoulders around 183.50 roughly to produce a weekly lower high and then just get some sort of continuation in the overall range. If we think about this from a Fibonacci perspective, we'll just measure the overall range that we have in front of us, and you can clearly see a slide back down underneath the 38.2. So very simply put, bears want to see price acceptance down here. Bulls want to see price acceptance up here. Lack of acceptance and a lack of acceptance. So nothing really surprising that the bears remain in the driver's seat over on small caps. The last thing we'll look at here is the volume profile just to keep it consistent. And we're right at the high volume node, the point of control, if you will. If we slip this, it's a little deceiving here. If I throw on a little bit more of a time frame, something like a 5-year time frame chart, you'll notice that this as a key area of support, that's that 163-ish zone we just discussed. But if we break down from it, even the volume profile would suggest a little bit more of a move lower, closer to like 156. So downward pressure is looking like a real threat out of small caps still, even if we consolidate for a little while longer. I mean, you have to imagine that this as a monthly bear flag, if it breaks down, imagine the number of positions that go off sides for anybody who is trying to buy the pullback over in small caps. It's just not a pretty sight at this point in time. So that relative weakness has kind of been a canary in the coal mine from this breakdown we've seen across the broad market. Here's the IWM daily time frame chart. Expected move is a little bit more neutral, noting that we have, again, the suggestion of an equal low, some sort of higher high, at least on the weekly count, or maybe it's even just an equal high to back here, but nonetheless still an opportunity to produce some sort of lower high from this sequence, right? Lower high, lower high, lower high, some sort of lower high here around roughly 177. So nothing really impressive about that. I mean, the breakdown point, if we get underneath that 169, we talked about the danger on the weekly time frame chart and how the door is really open to the downside. Anything in the grand scheme of things from the weekly, remember, we also talked about the neckline of the head and shoulders retest. That's here. You get your daily 200 SMA, confluence, very, very clear stuff. The only actionable setup that we have on small caps here comes from the hourly time frame chart. And if you watch the Wednesday update, if you really watched the any of the later in the week morning shows, we talked about hammer time up and over this set of highs in here. And we certainly did get that break, just like the remainder of the broad market. But once again, location-wise, in the grand scheme of things, this is not a very helpful breakout. We can trade scalp longs, and this will help build the case for a counter trend move to be established on the S&P and the NASDAQ if we get a higher low pullback, as long as we stay above this area here. Let's just round it off. Let's use nice round numbers. That's rule number 2, right? 172. As long as we're above that on the IWM, probably looking to favor short duration longs in the S&P and the NASDAQ. If we fail underneath that, then my goodness, kiss it goodbye. I would easily imagine a rotation back down to the bottom, noting that anybody who's long from in here is likely going to capitulate as soon as we start trading around their break even. So I could easily see a retracement back down to 169 on a failure of 172. Upside targets, quite clear. You can walk them up. We've got 174.75, and then as we were talking about on the daily, the equal/lower high around 177. Here are the Russell internals for the week, and you can see substantial outflows. Nothing was not substantial outflows, but sort of more aggressive outflows on a relative basis as compared to the NASDAQ and the S&P. And you can see that we got nowhere close to substantial inflows on the Friday rally. Same thing with trend lower zone to not making it to trend higher zone on the advanced decline line. The only saving grace is that the cumulative tick was a little bit stronger out of the Russell, but I didn't show you this on the S&P and NASDAQ, but whenever you get a read that does this and then flatlines into the close, it's not a very mild build. It's not a sustained read like what we have here. This is indicative of short squeeze. This, a gradual like 45-degree line, is much more indicative of just sustained buying pressure, which of course is a supporting piece of evidence for new money buyers getting involved. So short squeeze is the name of the game here in the small caps as well. Last way we can illustrate that is over here on the market profile. Extremely thin structure on the break up and over this area in here. We closed the prior single prints, leaving more in its wake. The Russell key line in the sand, if you're trading futures, anything over 1758, as long as we're above that, I would say that we're okay. If we start to break down from that, it gets really dangerous that a stronger retest of roughly 1750 is on the table. If we get the higher low here, okay, it keeps things kind of alive. Breaking back down underneath, nail in the coffin for the broad market. Let's change gears here a little bit and go back to our S&P sectors to kick off more supporting evidence. Feels a little bit disjointed to me, but hey, I give the people what they want. Let me know your thoughts down below in the comments section. How's the new format? Did you like it this week? Did you not like it? And then we'll sort of make another move based on the feedback round 2. What's going on from a sector perspective? So if we organize by who was leading, who was losing on the Friday session individually, what you'll notice is that utilities actually outperformed on Friday, up 2.69%. Is that a little bit of an outlier? It's possible. We know that utilities are classically extremely lightweight in terms of representation in the S&P, but also D for defensive. Just underneath, we have the tech sector, communications, and consumer discretionary, all up towards the top of the pack on Friday's breakout. So a little bit of a skew there if we're thinking about, did the risk on cohort lead Friday's breakout? If we examine by percent change on the week, at the top of the list is still that XLK, XLC, XLY is up here as well, but it's not nearly as substantial as the other sectors, only up 0.37%. At the bottom of the barrel, it's energy down a whopping 5.03%, really led by ExxonMobil to the downside this week, and also some other lighter weight risk off sectors. Consumer staples, utilities ultimately down on the week, down 2.29%. So maybe just a little bit of an oversold rally on the Friday session was what pushed that up towards the top of our daily organization. Let's take a look at these structural charts though and see how they continue to inform us for the upcoming week's worth of trade. I think that the XLK, although the break looks good, although we certainly have a beautiful little inverted head and shoulders, call it whatever you like, there is still the possibility for a weekly lower high on the back test of the breakdown point from the FOMC. Our daily 50 SMA, 170.25 is all eyes for the early stages of this week. Ideally, the bulls want to see a strong push through that and consolidation up here. They would also be okay with a higher low over the neckline of the inverted head and shoulders, 166.50, and an equal high attempt in short proximity of time to see if we can ultimately make that dream a reality. The sellers, you just got to push it back down underneath 166.50. You set your weekly lower high, and ideally the target over time would be back down towards the equal lows here. So that's the path going forward. It is bullish in its current form as long as we're over 166.50. My concern would just be if we set a weekly lower high, it's not looking good under 166.50. Next up, let's take a look at communications. What's going on with comms? What you'll notice is that we're really just more so in the midpoint of this as a range, approaching the upper third. This has really been a neutral force for markets. Remember that it never actually broke down on any of the substantial pullback over here, so kind of leave this one at face value. It's a neutral force for the broad market. Here's the healthcare sector, second heaviest weighted sector by market cap, but as we know, D for defensive. Ideally, this pushes into this range here. It gets us into the midpoint of this as an overall balance, and we just consolidate. The reason being is that you don't want defensives leading any sort of market recovery if you're more so a bull, and if you're a bear, you kind of just want to see it not doing much. You don't really want to see it pushing towards the top of the overall range. So this keeps the most people content in my eyes. If you're a bear, ideally, I mean, this is fine, but in a picture perfect world, you get something that looks like this. You just reject this as a midpoint of that overall range. So 130.25 is your line in the sand on the second heaviest weighted sector by market cap. Here's the XLY, classically more of an aggressive risk on style sector. Notice that it did not perform this week to the degree of the XLK, the XLC, any of that stuff. Really just producing a balance range, attempting to get over the top on Friday, but not, couldn't even do it, could not close above that 160.50 level. So watching that quite closely, and then even if we do break, I mean, there's a strong opportunity for just another rejection here at 163.25. We have terrible structure at the bottom of the overall balance in here, just like the S&P. I'd love to see the strongest thing for the buyers would actually be to see a breakdown first, repair the structure, maybe catch support off the daily 200, whatever, but then a rotation back into range puts look below and fail in force. You have an excess low. The sellers failed to continue lower. Then this as a daily, I don't know what the pattern might look like, but inverted head and shoulders, whatever, a recapture of 163.25 is the stronger bull thesis. Again, if we just look at this chart objectively, it's kind of neutral and maybe offering the potential for rejections or just lackluster price action underneath 163.25. So I don't really think that this speaks to an overly bullish market. Let's take a look at energy, just breaking down aggressively from this as an overhead balance, more so in the midpoint of what's now seeming like a lost year, doing nothing over in energy. So this is not helpful or really overly aggressive to the downside over in the broad market. Again, just put two and two together. With energy falling off of a cliff, the broad market, the S&P as a whole, didn't really budge. And the same thing could be said if we take a look at the XLP. This is really falling off of a cliff. Classically D for defensive, also a lightweight sector. Think about what the market did this week. It broke down on Tuesday, went sideways, and then rallied into Friday. So it just goes to show you that these lighter weight sectors truly are lightweight. I'm not just making that up here. If you take a look at the price action, it really speaks for itself. So this falling off of a cliff, utilities absolutely brutalized. If we do take out this level here, I do think you could see more so of a short squeeze over in Utes. So over 57.25, watch 58.65, and then really there's nothing stopping it until 61.40. Big potential weekly lower high here, so it's not going to reverse the curse, but potential for a squeeze in utilities if you're looking for a trade idea. Next up, we've got real estate, extremely rate sensitive. I mean, the 10-year just made a new high. The 30-year just made a new high. So with mortgage rates soaring, it's no surprise to see real estate taking a little bit of a back seat here and cooling off. Really lightweight sector. Let's take a look at materials, also a lightweight sector, balance range. It's not participating in the upside. And if we take a look over at industrials, a little bit of a move higher with a bullish engulfer on the Friday session. But once again, thinking about weekly trends here, is it not logical that after a near 100% retracement coming in towards this gap, a little bit of an oversold move, I can see the picture there. So the only bullish thing that happens is an inverted head and shoulders, and we're just not there yet. You need a higher low over 101, then a break of the neckline at 102.50. If we just consolidate down here, it's nothing more than bearish consolidation on the lows. Call it a bear flag. We ultimately look for the full 100% retracement. 96.75 is your target there. Financials, last but certainly not least in the sector lineup. I mean, talk about some damage done on the breakdown in this segment of the chart here. No hold of this breakout point. And remember, we did get a weekly higher low attempt at least at 33.65. It's all eyes on that. Are we going to produce a weekly lower high underneath? This is more like a daily lower high underneath, but the weekly lower high on a stronger daily uptrend to get there, I think that probably pairs the nicest with the overall S&P weekly thesis that we were just talking about, the daily thesis, the weekly thesis, how even if we do migrate higher on the intra-week, it's not really going to be enough to change our higher time frame trend. So XLF does strike me as being the highest threat at this point in time for the markets, as well as the XLK sort of failure on the backtest of the 50 SMA. It's not all doom and gloom. One of the things that we've classically been adding to the QQQ analysis, we'll throw it in here with the sectors, is SMH, the semis ETF, right? And what you'll notice here is just like the QQQ, if this is truly going to be a balance range, technically we have look below and fail. Might I add into an area of extremely thin structure, no follow through from the sellers. We got a higher low here and we actually broke to a higher high. So if this is going to play out as an inverted head and shoulders, you just want to see the SMH continue to remain over 147.25. Is there the argument to be made that there's the potential for a weekly lower high? Absolutely. And I think that really becomes more of a threat once you get back down underneath 143.40 again. So buyers are quite content here in the tech sector. This is more neutral, and this is lookout below. If you set a weekly lower high here, I think that's the nail in the coffin, and ultimately breaking down underneath these equal lows cause the thin structure retracement back down towards your daily 200 SMA. Obviously, further downside pressure on the broad market as a whole. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner on how to set this one up. Overall, I think that we've still got a mixed bag here. It's not fair to say that we've got risk-on revival or a full-blown flight to safety risk-off style look, even though the price action in the S&P clearly would suggest that there's somewhat of an issue. So the reason I say that is the XLK is the only thing outperforming, and yes, it technically is the heaviest weight risk-on style sector, but D for defensive healthcare is going sideways, holding up just fine. XLY is weak underneath a 50 SMA, and the XLF is also weak underneath a 50 SMA. We saw the damage here on the structural chart specific to financials. The only thing on a relative basis outperforming continues to be the XLC, caught sideways in its overall balance, and really it's not being helpful for a big break out of that balance just yet. It's not risk off though, because XLP is falling off of a cliff. Same thing with utilities, energy pulling back, and real estate is also a non-issue. If we take a look at some specialized ratios, I've got something interesting for us today on this one. We know that tech versus utilities classically would speak to risk on versus risk off, but with the commentary that the short-term yield right now is far more attractive in quote risk-free government-backed bonds, let's change utilities to the SHY, short-dated bonds, right? Let's take a look at that and see what this ratio turns into, and I think what you'll find is exactly what you might expect. SHY, there we go, so 1 to 3 years, right? If we take a look, this is actually in a downtrend All right, so this overall would speak to more of a risk-off move as this trends in the downward direction. The only thing that sort of looks more so apples to apples is the XLY over the XLP. This would speak to risk-on versus risk-off as well, but specific to consumer spending. And what you'll notice is that discretionary is technically outperforming here by just a little bit, trying to break out of this balance range in the upward direction after producing some sort of higher low. So you can continue to see the push and pull between some things suggesting that, okay, risk-on is trying to remain firm, but it's also not a pretty picture out there in the S&Ps. If anything, we're kind of recalling that right now mega cap tech is almost like the safe haven asset, as twisted as it seems to make a comment like that. Let's take a look at the dollar and see what's going on from this point of view. Straight line in the upward direction, inorganic price action, totally seems that way to me. We are getting a little bit of a pullback into the end of this week, but well above the upper bound of the overall daily or even weekly range at this point in time. Ideal higher low over 105.65, weekly higher low anywhere over 103.50. Certainly a contender to continue to put pressure on markets in the downward direction. Obviously, to produce this pullback, it eases some of the burden in the upward direction, and I do think that that would align with the counter trend move on the daily we've been discussing over in the S&Ps. This also aligns with that thesis because gold aggressively oversold here into these lows. If we get a counter trend snapback, it puts downward pressure on the dollar, relieving pressure on equities, and then if this just sets a lower high, because let's not get lost in the short-term oversold rally, it's just going to produce a weekly lower high anywhere underneath 1915. That then starts again the rally in the dollar and further pressure on equities over here. It's the same song and dance over on the silver contract, which might have already started its squeeze in the upward direction, getting a Friday close over the prior balance area. Your lower high is just anywhere underneath 2280. Let's take a look at the 10-year yield and see what's going on with the TNX, obviously breaking to a new higher high on the initial reaction from the jobs report on Friday. From a purely technical perspective, producing a higher high means that clearly you can produce a higher low and still very much so be in an overall uptrend. You can even look at the TYX, which is the 30-year down below. This would speak to mortgage demand just absolutely getting obliterated, also producing a big time higher high. I mean, we're talking about a 5% yield over there on the 30-year at this point in time. In terms of the Fed tracker tool, let's have a look at the ZT and then take a look at what it would suggest. ZT is still underneath this level here, suggesting likelihood for a pause is still on the table. Let's have a look. As expected, prolonged pause is still very much so on the table, and if anything, the rate hike should be coming somewhere in the December timeframe, with odds increasing from 35-ish% towards 42.43% into the Friday close after that NFP report. If we were to look at the compare tab on Friday before we get a skew on the current website, what you'll notice is the decreased odds for the pause, increased odds for the hike. Obviously, overwhelming favor is still for a pause, but that general interaction is worth understanding after the labor report came out. Speaking of the labor report, the only way to really look at this from a bearish perspective is to try to predict what the Fed is ultimately going to do. If you look at the unemployment rate, I mean, it came in flat, 3.8 in the August read and 3.8 in the September read. The only time where you get a severe and drawn-out recession is when lots of folks lose their jobs, because then they can't stimulate the economy, corporate earnings ultimately take a hit, and therefore the EPS of the S&P needs to move in the downward direction. So if we're going to continue to get these historically low unemployment rates, this is direct from the horse's mouth. You can say that the chefs out back cooked it up beautifully, but I mean, this is the data. This is what we have in front of us. If we take a look, and big shout out to Kathy Jones over on X for posting this, which of course is a Bloomberg terminal screenshot. So if you want to go follow her, she's an analyst over at Schwab. You can probably just follow me for the updates anyhow. Little plug. But what do we see here? I mean, what you want to take away is that the loss of jobs is getting less severe. You can see that there is no contracting particular sector, if you want to call it that, in the labor market that's contracting aggressively. The only thing that came in was information, and we are seeing an uptick in hiring. Pair this with the JOLTS number we got earlier on in the week. People are getting hired, and there are job openings. That is really not a recipe for a severe and drawn-out recession. So that, again, the only way to look at this in a bearish light is trying to predict that because the labor market remains tight, the Fed is going to raise rates once again and likely break something. And if that is the case, we'll take it in stride, but this is not indicative of a recession because of severe unemployment. Let's take a look at the not earnings calendar yet, but the economic calendar for the week. And what we'll remember is that we've got CPI. CPI is going to be a big deal because we know that we've slightly seen an uptick in overall inflation reads. And if this uptick continues, it forces the Fed's hand because we clearly have a strong labor market. They can probably afford one more rate hike into the end of the year, which we just explored is likely going to be in the December timeframe. CPI month over month is slated to come back down. The forecast is for a 0.3. Remember that prior was 0.6. This is an all eyes on moment. A little bit backwards here. Usually PPI is after CPI, but it's just the way the cards fell this time around. Thursday at 8:30, we will be live, donuts and coffee up in the penthouse. Come hang out and we'll see how the market reacts. In terms of earnings, it's right around the corner. Earnings season. It's going to kick off with bank earnings after the close, or excuse me, before the open on Friday. With JP Morgan, the heavy hitter, it's going to be interesting, right? We already saw that the XLF chart itself is fairly weak. If we're going to head towards a recession and financial companies are likely going to take a hit because of that, it's going to start showing up in these numbers. So JP Morgan's earnings call will be fairly important on Friday before the open. Let's get it right that time around. Let's take a look back on over at Thinkorswim for our risk appetite on this market. TLT ratioed to the S&P made a brand new lower low. We know that this relationship has been broken in terms of signaling flight to safety. Bonds have just been getting absolutely hammered. So if this is broken, we could take a look at bonds in relationship to themselves, not necessarily to the S&P equities. And if we do that, what you'll notice is that further out on the curve, rates are finally starting to act appropriately and move in the upward direction. That is really what you want to see, and you want to see these things come down if we're going to get more so in sync with the overall comfortable environment to avoid, so to speak, a recession, right? Short-term yields would come down a little bit. So far, it's still, as it currently stands, would indicate some sort of fear of uncertainty, right? Uncertain markets would be projecting higher yields right now. Right now, you can see that the SHY 1 year versus like 3 to 7's IEI is sitting on an equal high. So no good from that perspective. If we take a look at credit spreads, they continue to widen, which again is not really healthy for a bullish market. This is moving in the upward direction. This is moving in the upward direction. Both of them making new higher highs can certainly afford higher low pullbacks and remain on this trajectory here, furthering pressure on equities to the downside. If we look at the HYG in isolation, we've been doing this on a yearly time frame chart. Let's do this over here. The main takeaway is not only, again, that just directionally as a vector, this would suggest lower, right? On a relative basis, we're underneath this area. We're not talking about exact numbers. We're not forecasting S&P belongs down here at 3,900. But the next sort of watch, of course, would be if this forms a lower high underneath the balance and the S&P diverts and tries to make a higher low above the balance, that's a big red flag. I would not be a believer in any sort of market rally if that is the case. How about Bitcoin, the digital gold? What's going on over there? Taking a look at the BTC. Ironically enough, through all of this, it's remained the store of value. I mean, who would have thought in a million years, but it is holding up. It's inside of this range. Now, is there the possibility for a beautiful head and shoulders to emerge? There absolutely is, but until we break down through that neckline, this remains relatively strong to the broad market as a whole. A very, very interesting dynamic there. How about the market breadth as this breakdown has unfolded? New highs versus lows. This is incredibly important to understand here. Remember that the S&P weekly produced a green candle, meaning that it did technically move into the previous range. It closed inside. We did that whole analysis on the weekly, right? Why is it that new highs versus lows made a new lower low? This speaks to breadth deterioration. Once again, not buying into a trend reversal right now in our S&Ps. Same concept over here on the SPX A200R. We made a weekly sort of closed back inside of range, and this made a lower low. Breadth deterioration, even though the market tried to make an attempt in the upward direction. SPX A50R, this is what we talked about on Wednesday. Down here in oversold territory, yeah, it did make a counter trend move, and it is playing nicely with what we've seen in the broad market, but is there still an opportunity for like a weekly lower high anywhere underneath? You know, what is that, roughly 30%? Absolutely. This keeps the market bearish. You really see a stronger recovery when this gets up and over 50% to begin. That is it for the SPX A's. Let's take a look at the RSP, which is your equal weight S&P, and this is coming in for a back test of that 140. It's do or die here. Just like the HYG, if this forms a lower high underneath, I mean, kiss it goodbye. You should not trust this with any sort of confidence over in the S&P for a stronger reversal in the upward direction, considering that right now, all of the trends point in the downward direction. We could do the same thing and throw the QQQE in here since we are sort of changing up the format a little bit in today's episode. And what you'll notice here is that the QQQE also has a stronger opportunity to produce some sort of lower high. It did not break from its balance range as cleanly as the weighted QQQ, and even if it did, I mean, we're talking about a lower high here to certainly keep things in the bears' favor. How about the Dow? What's going on with our Dow? And the biggest implication and takeaway that we've had in this one over the past couple of weeks is the look above and fail, right? And the look above and fail into this range would suggest that the bottom is the target, furthering headwinds for the broad market as a whole. Now, the next thing to pay attention to in this particular relationship is this level right here at 14.7 on transports. If that can hold and we stay in the midpoint of this range, okay, maybe it keeps things alive. But if this just breaks on down through 14.7, I would certainly expect the bottom of the range over here in industrials. And that, of course, once again, provides a headwind for the broad market as a whole. Let's take a look at volatility to wrap up and conclude our supporting evidence. Once again, leave me some feedback in the comments section. I feel like flipping the script like this has actually lengthened the video. We will ultimately see. VIX had a down week. VIX had a down week, which is no surprise, inverse almost to our S&P, but it's still elevated. That's certainly, worth respecting here. If you were to just draw this level in around, 1725, is it 17 flat? I mean, consolidation here certainly leaves the door open for a capitulation spike up and over 2050. We haven't seen the capitulation spike, but if we were to sweep these lows so let's just say this is a hypothetical, right? We set a lower high on the daily, consolidate, sweep the lows, I maybe wouldn't put my net worth on it, but I would bet that there's a move up and over 2050 in the VIX. We also know that the precursor is always going to be the VVIX, the volatility of the volatility index, backing off of that 103, but still on some sort of higher low trajectory. Anything that consolidates and breaks here, again, that's your heads up that the VIX itself is likely going to go for that capitulation move over the 2050. What about volatility futures? Because right now VIX and VVIX would suggest things are staying contained. Notice what happened with the volatility futures into the end of the week. The market rallied, did it not? What did volatility futures do? They actually moved closer towards a backwardation. Now, granted, we're not at zero, we're not over zero, we're not positive, but you would have thought on a move like Friday, this would have backed off aggressively, somewhere back down over here. Certainly was not the case. So seeing that minor uptick continues to show me that, once again, we can talk about a counter trend move, but nothing about any of the supporting evidence thus far would be overly suggestive about a stronger reversal for like new all-time highs or a big new swing high in the S&P just yet. If you've made it to this point in the show, I'm sure you're enjoying the analysis. Once again, your feedback is greatly appreciated in the comment section. Did you like the new format, or did it just really lengthen the video and confuse things? I'm tending to think that it lengthened the video and kind of flustered with the flow, but we'll see. Apple daily time frame chart. Here is the balance range firmly back within 174, wants to produce any higher lows on a pullback, and then the buyers are looking for a rotation back up towards that 180. We do have a gap overhead to close. 180-150 is the level, and for all the pattern traders, you could start to imagine how this turns into a daily inverted head and shoulders for a stronger bottom. We did support, in hindsight, it starts to look a little bit more obvious, right? Around that daily 200 SMA, I'm honestly a little impressed that we did not produce a lower high underneath this as a balance area. If we take a look on the hourly time frame chart, once again, Friday's move nearly vertical. I would not be a buyer of the highs over here chasing that. I would look for consolidation. Picture perfect is over 176.50, but as we just talked about, anything over 174 still keeps the hopes alive and remains above that 174 level right here. You could start thinking of this as just an hourly ascending triangle, right? Break, retest, higher low, good to go back in the upward direction. Bears have the stronger upper hand if we fail the 174. That one's fairly straightforward. Here's Netflix. Finally, something that's, the price action is finally starting to reveal a little bit of structure. It's not just lower every single day, like a never-ending sort of, drift. But what do we see here? We're back in the balance range. So look below and fail is totally on the table. Higher lows over 379 early in the week, trade towards the top of the range at 384.75. If we break here, looking for a move in the upward direction, we've got this really weird spike to contend with. I would ultimately start thinking about how we can move through that thin structure sooner rather than later. Failing the 379 just continues balance, and I probably put this back on the back burner as a lackluster name to be trading. Let's take a look at Tesla. What's going on with Tesla? Really interested in the activity, especially noting the gap on Friday to the downside. It supported. It did support right off of that 254.25. We had it mapped as 255. We've updated that ever so slightly to the open and little interaction there on Friday. But as long as we're above that, it remains bullish. So perfect higher lows are pullbacks over 258. equal high attempt in short proximity of time here, gets us for the breakout through the thin structure looking left and into this as a prior range. Over 261.75 target becomes 268.50. If we're just chopping around in here, let it build out a range and then wait for something constructive that looks like this. Sellers, ideally you look for a lower high underneath 254.25 if it's going to sell back off to our next support at 244.75. Next up is GOOGL. What's going on with the Goog? Strong break. Again, this one has had the most relative strength, I would say, over the last little bit. We even had to go, if we just go back to the daily time frame chart, we had to go way back in history. Here we go. Let's really rewind the clock 3 years or so. You'll notice we're dealing with these areas from back here. So substantial move in Google, definitely some relative strength. The trend on the daily is clearly strong. We're coming into an equal high. So is it worth at least respecting the idea that if we do see upside, a pullback is reasonable for a higher low and then a break? Sure, absolutely. You get some sort of ascending triangle on the daily. Here it is back on the hourly time frame chart to be a little bit more specific with those levels. In a picture perfect world, the higher lower consolidation is over 136.75. You're trading for an equal high break to get into this area of resistance in the first place. 139s, then your gap closes at 140.40. If we do see the pullback, again, this consolidation over time, I would say a span of at least 1 or 2 days sets up the ideal break in the upward direction as well. The deeper pullback and shorts can trade this for a thin structure retracement is this, and then finding support off of this as a retest level at 135.25. That is Google in a nutshell. Next up is Metaverse, Zuckerberg's Fantasyland. Strong break. The one thing to point out here is that we can be jaded about, all we want. We can be jaded all we want about how disrespectful this price action was in here, but ultimately on the daily time frame chart, this was a substantial exit from a long duration range. So the fact that the market consolidated ultimately sideways here in Meta for this amount of time, the longer the consolidation, usually the larger the break. So this is the first time that we've actually seen a strong daily close outside of an established range. This is just a wick. So if this is going to continue, clearly the daily case to be made is a higher low over 310.75, 318, 325.50. Those become your upper targets, right? So as long as we're over 310.75, good to go. If we do fail that and come back down underneath for a lower high, no comment. No comment. Put it back in the range, and we'll just let that one simmer off, and the metaverse will remain a fantasy until it wants to cooperate and play nicely. What's going on with NVIDIA? Stronger recapture. Again, multiple attempts here. I thought a lower high was going to be produced. Firstly here, secondly there. Clearly produced a higher high now on the daily time frame chart in this area. So trying to keep my wits about me and trying to inform you to keep your wits about you as we navigate this now as just a balance range. We don't really have a clear trend, and always when we're in the midpoint of a range, we don't really have an edge. The edge exists at the edge for a break or mean reversion, or a break, right? Here it is on the hourly time frame chart, and you can see that thin structure break from Friday. So pullbacks, picture perfect, over 454 gets continuation. Next target overhead, 467. If we do break down, you want to see a higher low produced over 445, and then from there, I would really just take it in stride. I do have to, again, give the buyers the benefit of the doubt in this situation, noting that we gapped down near or not technically a true gap, but we opened lower, closer to this retest point after getting a close over 445. This was seeming like a lower high, and just like the S&P, just like everything else, not even a hiccup, as we just breached right through that level and closed even exceeding this prior high in the past. So a little bit of the benefit of the doubt to the buyers, but once again, thinking about how can you get involved on a pullback to control your risk. Next up is going to be Microsoft. What's going on over here? Same old thing. Stronger pullbacks stay above 321, and then you're looking for an equal high target up here closer to 329. Straight up continuation. That is the story here. I would probably give it a little bit more time to, number one, time to pass as we let this try to build out a higher low here. And I would also not be overly prescriptive about looking for exactness and precision, I guess is what you would just say. If you break here, don't be surprised if it's a sloppy higher low that tries to be found around these areas, right? This thin structure wants to be retraced, but if Microsoft is really going to remain strong, it'll stay over that 329, or just kind of it won't really want to go all the way, right? All the way back down to that 321 is the reference. So that's the look there. Here it is on a daily time frame chart, just to give you the higher time frame overview. It recaptured the 50 SMA. So again, something that breaks and then kind of does this, stays above that 50 SMA, a little bit more constructive for this retracement up towards 337 over time. Let's take a look last but not least at the mini beast. We've got Amazon, and then 3 additional trade ideas, and you are on your way from this very long weekend update. But hey, you asked for it. What do we see over here on Amazon? Nothing. We just see a balance range. If I just go to the hourly, just to have some laughs with you guys once again, I mean, Wednesday, what are those, right? Bust out the meme. What are those? Just absolutely terrible price action on Wednesday. Bounced off the bottom of the range on Friday, still contained within the overall range. Keep it simple, over 129, under 124. All right, seriously, if you've made it to this point in the video, you truly owe me some feedback down below in the comments section. Is it too long? Did you like the format? Did you not? It's the last time I'll ask. What do we see here? First trade ideas on AMAT for applied materials. If this is going to turn into an inverted head and shoulders, if it's going to cooperate just like the SMH semis did, then you will look for a gap close overhead. Breaking over 140, 140 closes this gap to the 50 SMA on the daily and our prior structural lows at 143.85. Anything beyond that, your next target would be 147. I'm not interested in the trade if we break down underneath 138. Here it is on the hourly time frame chart. You can see that's exactly where we opened on the Friday session. Initial flush, we really don't want to get back down underneath that area. The sellers tried and they failed miserably. So if they get a second attempt, you better believe they're probably going to take their chance and try a little bit harder on the second go around. So that's applied materials, looking for upside, inverted head and shoulders, gap close overhead as a target. Next up is going to be IBM. What's going on with Watson? Let's take a look at Watson. What do we see? Certainly the potential for a longer time frame head and shoulders. So if we want to align a trade idea with the overall S&P and you're really looking for an individual name, this is what you want to look for here. Counter trend rally continues a little bit this week. We find a lower high underneath the daily 50 SMA, underneath prior structure. 145 sets a lower high, and lo and behold, you have yourself a head and shoulders. It's not quite a Man Ray pattern, maybe a little bit if you want to count that. But you get the gist, right? Looking for something like that, and then your neckline break is underneath 139.50, target daily 200 SMA, and 135 flat. This one requires a little bit of patience to look for that lower high to be set first. Last but certainly not least is Caterpillar. What's going on with ticker CAT? Possible rejection of an overhead balance, right? There's your overhead balance, broke down like everything else, and now there's the opportunity for a lower high up against 270. So if the broad market remains weak, if the entire rally from Friday gets wiped back away, we find ourselves back in the balance range, Caterpillar is a great opportunity for a lower high because the risk, right, that your stop just goes right over that level. Look for the equal low and then possible follow through. I mean, maybe the daily 200 SMA, we'd walk down targets from there. So that is going to conclude today's ceremony of the weekend update. I'm sure it was a long one. I've not compiled all the clips yet, but I know it's probably longer than average. So once again, I appreciate any feedback down below in the comments section. If you learned something new or enjoyed it, let me know down there, or just by giving the video a very simple thumbs up. We hope to see you in the penthouse suite on Monday morning for the pre-market prep. That's 8:15 Eastern time. And with that being said, I wish you a green trading week.